Hey, this is Meir Valensky with Driving Markets. Good morning. Hope you're well. Well, okay, so I took off Thursday afternoon and Friday due to the Jewish festival of Passover, so I was out of touch with markets. And when I came back on Saturday night and looked at what's going on, I thought, wow, what a complete and utter trashing of financial markets across the board, all on the back of what? On the back of fear of interest rates. In other words, Jerome Powell gave a speech to the IMF, the International Monetary Fund, and stated that interest rates will need to rise a lot more aggressively before they get control of inflation. Now, he stated that very clearly back on Thursday, and that sent the markets down on Thursday and on Friday. Why? Because he said that interest rates will have to go up by 50 basis points in the May meeting of the FOMC, the Federal Open Market Committee. Now, I've been saying since the beginning of the year that rates going up at 0.25, 25 basis points is simply not sufficient to control inflation. It is well out of control. However, what happened was that everyone poo-pooed that idea and said, no, you've been extreme, there's no need for that, everything's fine, it's all rosy. And I said, it's not all rosy. I said, inflation is out of control. Thus, the banks started in February to say, the Goldman Sachs, Bank of America, they started to state clearly that interest rates need to rise significantly, and their forecast was 4.5% by the end of the year. I already gave that forecast back in January. So what's likely to happen now? I can see the forecast being 5 to 5.5% in the States and in the UK, simply because interest rates are not high enough and the central banks are well behind the curve. And once you have interest rates, once you have inflation running at the high levels that it is, and the central banks seem to living in this rose-tinted coloured glasses world where they think everything's going to be okay. They even said back in February that by the end of April, inflation would start to go down. On the basis of what? Where did they get that statement from? And yet the financial markets are very keen in looking for any type of positive news, simply because there's huge amounts of money sitting there to be invested, and it's in the interest of the actual banks and investment companies to push the markets higher. However, what I'm stressing specifically here is when you look at core inflation and you look at raging inflation. So core inflation is or declared inflation running at 7%, 8.5%, 7% in the UK, 8.5% in the States. That inflation is not real. The real inflation is 18 to 20%, which I've been saying over and over again. And therefore, interest rates have to rise significantly. Where's that going to have an effect? It's going to have an effect first and foremost on the housing market, and secondly on our housing market and mortgages. In other words, the consumer is going to be spending a lot more money per month on maintaining their mortgage. Now, if they can't afford to maintain that mortgage, that is going to increase defaults within the mortgage market and put pressure on those lending institutions as to take action what to do. Either they absorb the default and give the client more time to pay it off, or they go for repossession. If they go for repossessions, that could have an impact on the housing market to such a degree you could see a crash. Who knows? This is all speculation at the moment, but that could happen. By the end of the year, as I've stated several times, you could have mortgage rates, fixed rates on 5 years running at 5.9 to 6%. Now that is a big difference from those people who are paying at the moment 1% or 1.5% or 2%. Where's that money going to come from on those consumers' individual expenses and salaries? It's going to have an impact. Look at the 10-year bond. The 10-year bond rose to the high since 2018 at 2.95%. So I've always said on all my videos and broadcasts, look at the bonds. The bonds are rising higher in anticipation of rising interest rates. One of the biggest victims of rising interest rates is the Nasdaq. The Nasdaq on Friday went down 2.8%. Why? Because it's highly speculative, it's high risk, it's high growth, and therefore investors will pull money out of that and rather go to a solid, safer investment in uncertain times to get a guaranteed return on their money. So if interest rates are going to rise, then you're going to have the Nasdaq being the number one victim it's going to be impacted by rising interest rates. So if we look at what happened on Friday in terms of the tech stocks, all the Amazons, the Googles, the Salesforce, the Apples, the Netflix went down even further, and Facebook, Meta, as a result of rising interest rates. Just to focus a little bit on Netflix, by the way, I think Netflix has a lot further to fall purely on what is reported last week, and in light of a higher interest rate environment, Netflix will be affected even more because it's a high tech stock. Look at that. Also, you've got oil came off and gold came off. So why did oil come off and why did gold come off? Because in a genuine environment where markets are going down, then all asset classes, whether they're commodities, whether they're shares, whether they're trusts, whether they're investments, or your 401k, all of them go down. Everything goes down, and therefore investors pull money out and they fly into safe havens, which is normally cash in this particular environment. So you have to keep an eye on that. What's likely to happen to go forward? Well, the UK will probably raise interest rates by 50 basis points in its May meeting, and the US will, I'd say, odds-on favourite, are going to raise their interest rates by 0.50 basis points also in the States, and that will continue month on month at every meeting. Even in between the meetings, it might happen. So this is Meir Walensky with Driving Markets. Catch me on LinkedIn, WhatsApp, YouTube, Instagram. Hope you have a good day. Speak to you soon.